I'm Ivan Gruhl, Co-Chief Investment Officer with Avantax. Today we will provide a market update for January. We'll start with a recap of returns for December and then shift to a discussion around the key themes that are top of mind as we head into the new year. The past 12 months brought another impressive year of returns for equity investors, who saw the S&P 500 surge more than 25% in total return for the second consecutive year. Over the course of 2024, the S&P 500 notched 57 record highs, placing the past year in the top 5 historically for new record highs. Elsewhere, returns were strong but failed to keep pace with U.S. large caps. The Russell 2000 finished the year higher by more than 11.5%, as higher interest rates constrained the floating rate debt-heavy small cap index. Meanwhile, international developed stocks were higher by about 4.5%, while emerging market stocks were higher by more than 8%. A more sluggish economic backdrop paired with a stronger dollar remained key headwinds for U.S. investors in foreign markets over the past year. In bonds, stubbornly high interest rates made for a challenging backdrop for bond investors. After starting the year at about 3.9%, the yield on the 10-year Treasury note finished the year around 4.6%. Despite the higher interest rate environment, both taxable and municipal bonds managed positive returns of about 1.25% for taxable bonds and 1% for munis over the past year. As we set our sights on 2025, there are several key themes that grab our attention in the year ahead. For stocks, earnings remain at the top of the list. Analysts expect the S&P 500 earnings to grow at an impressive clip of nearly 15% in the year ahead, well above the 10-year average of about 8%. Notably, analysts believe that earnings growth for companies outside of the Magnificent Seven will improve considerably over the coming months. This is important because, as you can see in this next chart, the Magnificent Seven stocks have been responsible for the bulk of earnings growth over the past couple of years, and subsequently have seen the strongest returns. With market concentration and valuations sitting well above averages heading into 2025, strong earnings will be a key catalyst to see the next leg higher in this currently 2-year-old bull market. While the outlook for both the markets and economy remains strong, there are potential risks that will command our attention as we look to the year ahead. With the incoming administration set to take office on January 20th, we are almost certain to see tariffs put into effect. We can expect to see more tariffs on China and other key exporters, which could lead to an uptick in goods inflation, an area where inflation has been quite low recently. This could create a dilemma for the Federal Reserve, which recently dialed back their expectation for interest rate cuts due to higher inflation forecasts, as well as stronger economic growth. If the Fed is forced to keep monetary policy restrictive to stave off inflationary pressures, it could be enough to push the economy into a mild recession, particularly against the current backdrop of a softening labor market. Bringing it all together, we continue to see plenty of positive news priced into the stock market, reflected in elevated valuations, particularly in the United States. This is not unexpected given the incredibly strong earnings backdrop and generally upbeat economic outlook. With lofty expectations and valuations in certain pockets of the market, we continue to stress the importance of diversification in portfolios. This final chart shows the concentration of the top 10 stocks in the S&P 500 over time. As you can see, index concentration is near record level, with the top 10 stocks in the S&P 500 representing nearly 40% of the index. While it can be easy to get caught up in what has been working recently, we continue to lean on the merits of diversification and constructing portfolios that are equipped to endure a wide range of market environments. So that's what we have for this month. Thank you for watching and have a great day.